We're told a lie the moment we earn our first paycheck. It's polite, it's safe, it's middle-class gospel. Work hard, save your money, avoid debt. One day, buy a home. So you do exactly that. You scrape together $40,000 for a down payment. You starve your lifestyle for 3 years. You delay vacations. You delay life. Eventually, you win. You buy the house. You feel proud. But while you were saving, someone else, maybe earning less than you, bought a bigger building on the same street. They didn't use their money, not $1. And here's the part no one tells you. Mathematically, they are infinitely wealthier than you the moment they sign the paper. This isn't illegal. It isn't a scam. It's a structural anomaly in the U.S. housing market called the VA loan. Most people think it's just a benefit. Experienced investors know better. It is the most powerful wealth-building lever available to an individual in America today. Today on Moneta, we're not talking about buying a house. We're breaking down the psychology of leverage, the math of infinite returns, and why avoiding debt may be the exact reason you stay poor. It isn't large, it's undefined, it's infinite. That instinct still fires today when you see a negative $400,000 balance on a mortgage statement. But this is not the ancient world. In a modern fiat economy, not all debt is equal. There is consumer debt. Debt for cars, clothes, vacations. Debt that consumes your future labor. That is cancerous debt. And then there is productive debt. Debt used to acquire assets that produce income and appreciation. The VA loan gives you productive debt with 0% down. Pause on that. Traditional investors need skin in the game, 20% equity to control an asset. The VA loan removes the skin. You control 100% of the asset with 0% of the equity. Archimedes said, "Give me a lever long enough, and I shall move the world." The VA loan is the longest lever in the American financial system. But here's the trap. Because it requires no money down, many veterans treat it casually. They buy lifestyle, they buy square footage, they buy comfort, and the lever crushes them. The wealthy don't see a monthly payment. They see capital control. If you control a $500,000 asset with $0 invested, your ROI isn't small. Let's talk numbers. This is where most people check out, and where fortunes quietly diverge. Meet two twins. Twin A follows conventional wisdom. He buys a $400,000 single-family home with an FHA loan. He puts 3.5% down, about $14,000, plus closing costs. He lives there. He pays the mortgage from his paycheck. Result? Shelter, but negative cash and a monthly liability. Twin B watches Moneta. He uses the VA loan. Same price, $400,000. But instead of a house, he buys a fourplex. 0 down. He lives in 1 unit. He rents the other 3. Mortgage, $3,000 a month. Rent, $1,000 per unit, times 3 units equals $3,000. Income minus expense equals 0. He lives for free. Now the real math. The property appreciates 5% in a year. That's $20,000 in equity. Twin A earns 5% on $14,000. Twin B earns $20,000 on 0. What's the return on 0? The calculator breaks. This is called house hacking. Civilians can do it with small down payments. Veterans can do it with nothing. This is the closest thing to a free lunch in modern economics. Philosophy is useless without execution. Here's how this works in the real world. Step 1. The certificate of eligibility, your golden ticket, proof of service. Without it, you're just another borrower. Step 2. Owner occupancy. You must live in the property for at least 1 year. That's the rule. This is why house hacking is non-negotiable. You're not buying a remote rental. You're becoming both landlord and neighbor. Step 3. Small multifamily. 2 to 4 units only. 5 units or more becomes commercial, and the VA won't touch it. You're hunting for self-liquidating debt, where rent pays the mortgage. Step 4. Reserves. Zero down does not mean zero responsibility. Keep cash. The smartest move? Take the down payment you would have used and keep it liquid. That's your margin of safety. If this works so well, why doesn't everyone win? Because of comfort. When people get approved for $500,000, they don't think asset. They think upgrade, bigger house, better finishes, maximum debt to income. One job loss later, they're trapped. The VA loan becomes a consumer product instead of a wealth tool. The Moneta path is different. It requires discomfort, temporarily. Shared walls, smaller space, delayed gratification. But after 1 year, you move out, you rent your unit. Now all 4 units pay you. Comfort is the trap. Strategy is the escape. We live in an inflationary era. Cash loses value every year. Debt gets cheaper. That $3,000 mortgage payment won't feel heavy a decade from now, but the asset will be worth more. Using the VA loan means you are shorting the dollar, borrowing depreciating money to buy appreciating assets. You earned this tool through service. It's not a gift, it's compensation. And like any tool, it can build a prison or a foundation of freedom. Don't fear leverage. Respect it. Study the market. Buy multifamily. Keep reserves high. Keep lifestyle low. Do that, and you won't just own a home. You'll own your future. If this brought value, subscribe to Moneta. No hype, just clarity.